By most accounts, Canada's economy appears to be on a track for soft landing, but not without potential risks. So how does an investor navigate the Canadian market? Well, TD Cowen has just released a report called Canada Best Ideas Market Strategy, which addresses some of the key macro themes and offers a compilation of investment ideas. Joining us to discuss the report is AP Hardy, Head of Canadian Research, and Andrew Kelvin, Head of Canadian and Global Rate Strategy, both with TD Securities. Nice to have you both here.
Thank you. Thanks for having us.
This is a great report, I might say. I've gone through it. I've got it all marked up and highlighted. Why? Why did you put this together?
This is part of a family of Best Ideas product that Cowen has done for years. So there's a Canada Best Ideas product. This was the first iteration, but there's a US Best Ideas, European Best Ideas, Best ESG Ideas, and something that we'll be doing yearly and is very impactful for our investor clients. And it's a collaborative piece, as you mentioned, with TD Strategy Group, as well as obviously many different equity analysts participating. There are 18 high conviction ideas in this report. And what we're really excited about, I mentioned the work we're doing with Cowen, is TD historically was a very good Canadian focused research department with about 300 stocks. And now with 1,300 stocks globally, we're part of a very big family where we can go really in depth on topic that matters to global industries, of which Canadian companies obviously take part in, and it matters to them, and we're able to dig in much deeper than we ever were.
It's excellent, and we'll talk about some of the details of the ideas as well. I'm sure people are like, we want to hear. Before we get though, there's a few themes that were covered in this as well too, just to kind of set the macro environment, more just about Canada. And maybe let's talk about first the health of the consumer and household spending. So what are your thoughts on that? How healthy is the consumer?
So what I would say with the consumer is that I've been, and this is going to sound counterintuitive given the sort of very legitimate stress that I think a lot of people feel around household balance sheets and finances right now. I've actually been impressed with the resilience of the Canadian household sector through 2024 thus far. Mm-hmm. Obviously, we are now are starting to unwind it, but we saw a very significant tightening cycle through the last few years. And one of the things that's characterized Canadian households for many years now is quite a high level of household debt. I think a lot of people have pointed to that household debt as sort of the secret ingredient that fueled Canada's expansion. And households are around 60% of the mix in GDP, just household spending. And that's before you put residential investment into the picture. So it's very important for the economy. As the consumer goes, so goes the economy. Now, with the high level of debt, with the high interest rates, I think a lot of people have been very concerned that 2024 would be the year where households really had to, sort of pay the piper, as it were. Yeah. There was this idea that the high debt levels and high interest rates were going to combine to produce a very soft economic outcome. And while I don't think you would say 2024 has been a fantastically strong year for the Canadian household sector, it's been better than I think a lot of people have feared. So I think that's really the theme, despite the high cost of living, despite the fact that consumer sentiment has been weak for a lot of this year, though it has improved in recent readings, the household sector has held up better than I think feared.
Yeah, there's a lot of resiliency where people didn't expect it overall. You're right. The one thing I think people have been watching as well too is mortgages, excuse me, and then of course the upcoming resets that could be happening. You were paying some ridiculously low mortgage rate that was locked in. Now you're going to have a whole new world of mortgage payments. So what is your take on that, and how resilient, or what we should be prepared for in the upcoming year?
So I think Canadian households have proven a lot more flexible than perhaps people had anticipated with regards to how they are dealing with mortgage payments. So we actually did prepare a chart for this.
We're going to bring
so I'll
it
just
up.
refer to the chart. It's either that or I draw lines in my hands, which isn't good for anybody.
We're glad we had the chart. I'm sure you're very talented. But
so what this chart does, this is our estimate of mortgage resets by year based on data from chartered banks. So it is a bit of a messy chart, I grant, but it's important. So the y-axis, the vertical axis, that's the amount of fixed rate mortgages that we estimate will reset in a given year. The colored bars are what the tenor of the mortgage was at origination, and the numbers are what that average rate was at origination. So you can see 2024, we actually had a really big increase in mortgages resetting. So we've already sort of confronted one of these mortgage reset walls, as it were, and we didn't see growth really slow in Canada. Growth in 2024 on an average annual basis is expected to be just a little bit above 1%, which is about what it was last year. Again, that's not a spectacularly strong story, but it's something that suggests that maybe there isn't another shoe left to drop. We've seen a couple things happen here of households. We have seen changes in the way debt repayments occur. We've seen, well, interest payments as a share of household income have increased, which makes sense, the interest rates are higher. The overall share of household incomes that have been going towards debt repayments has been stable for about 4 quarters. Households are adjusting. The other thing that changed after the pandemic, and I always hesitate to use the word permanently, because nothing's ever permanent in macro. It's a great way of saying something that looks foolish in 2 to 3 years. But one of the things I used to talk a lot about before the pandemic was this persistently low rate of household savings. Since the pandemic, obviously when we were all locked away, unable to go out and consume services, households accrued quite a bit of savings. The idea was that once everything reopened, we would draw those savings down. And that is what happened in the United States. That is what happened in Australia. That is not what happened in Canada. The savings rate has remained very high. It was almost 7% in the last quarter. So households in Canada, they are sitting on in aggregate, not all the way through income distribution, but in aggregate, a pretty decent savings buffer. And on top of that, we have this sort of demonstrated resilience in terms of the ability of households to manage these sort of interest rate resets. Now, 2025 will be another test. 5 years is the most common tenor for mortgages.
Yep.
And if we subtract 5 from 2020 and 25, we get 2020, and we had extremely low interest rate environments. So it will be another test. But the volume of mortgages that will be resetting to higher rates is probably similar to what we saw in 2024, maybe a little bit higher. But a quarter of the mortgages that we reset next year will be to lower rates, most likely. And we have seen interest rates in the economy move lower through this year. We do expect that to continue through the latter part of 2024 and into 2025 to some extent, which will help buffer things as well. So the overall view here, it's not that things are great, but it's that 2025 can look a lot like 2024 for much of the year for the consumer.
I want to squeeze this in because I think it's important. I've only got about 30 seconds though. Demographics. When you look at Canada's demographics for the upcoming year or beyond, what is the most material thing to pay attention to?
It's the biggest downside risk, more than the resets, I would say.
Yeah.
Because the large composition of population growth with students, they don't have the same impact necessarily as the average Canadian household. So we're going to be reducing the growth in non-permanent residents, in students. That is going to have negative impacts for GDP for activity as a whole, but the magnitude is rather uncertain.
And we just want to note, for full disclosure on companies covered by TD Cowen, a division of TD Securities, please see the link to the TD Cowen website at the end of the show. All right, let's talk about some ideas. You did a wonderful job setting up the Canadian economy. Worth noting, though, these ideas do not depend just on the Canadian economy. They're Canadian companies domiciled, but of course the world. One of the best ideas you highlight is Celestica. How come?
Yeah, so one of the things I should quickly say is I talked a little bit about the family of best ideas products earlier. Another product that we're very proud of at TD Cowen is our Ahead of the Curve series. And in these reports, we dig deep on topics, we have analysts collaborate, we look very far out in the future. And one of the areas where we've done a lot of work is the growth of artificial intelligence and the arms race around artificial intelligence that these cloud service providers are all taking part in. So there's been a lot of growth, there will be a lot of growth, and with that growth comes the requirement for servers, for computers, for data centers, for networking equipment, and a company like Celestica is very well positioned to provide that equipment, to provide the services and manufacturing to these companies as they expand rapidly. And that's a theme that's going to last for years and is not dependent on the growth of the Canadian customer.
It's interesting too, because I was going to say that I was admiring how the thesis is laid out in the research report, because you talk about what is underappreciated or misunderstood and catalysts and milestones to watch. So well put together. I read a lot of these, that's why I was saying. But so you talk about the AI, these are the shovels and picks to we think about the gold rush and Celestica's like that. Another name that you highlight, and I think thematically is sort of in the same category, is Brookfield. But specifically Brookfield Renewable Partners. Yeah,
you're correct. So the amount of data processing, of computing power, of power usage that is driven by AI is just immense. and it will only grow. And a lot of these companies have their own sustainability agendas and are particularly keen on sourcing clean power. And a company like Brookfield Renewable, which is a Canadian company, but it's a very, very global company in terms of its operations, is quite well positioned. They've got hydro, solar, wind power, and are very well positioned to take advantage of this growth in demand for renewable power. And the agreement that they have signed with Microsoft to provide power to them from 2026 to 2030 for a portion of their data centers only exemplifies how well positioned they are to participate in that growth.
Yeah, it's so interesting just to hear these companies trying to lock up power supply as they're doing this. And I think the one that probably caught my attention was, I think Microsoft did some work with a nuclear facility that was close by to it, but Brookfield is another one that they have in there as well too. The last one is interesting too, and again, we're only touching 3 of the 18 today, so people will have to get their hands on a report if they're interested in the other 15. CIBC.
Yeah, so going back to what Andrew was talking about earlier, mortgage renewals and the fear around how much that was going to impact the Canadian consumer really weighed on Canadian bank stocks in the last year. And as it became evident, as Andrew was saying, that the consumer was managing better than feared, you've actually seen Canadian bank stocks perform better in recent months. And why we like CIBC in particular, it's really 3 things. They are growing quite fast relative to their peers. Driven by net interest income and wealth management fees and trading commissions. Their credit losses have been coming down. They had some issues in office real estate in the US, and those issues have abated. And they're very, very well capitalized and in fact are buying back stock. And in spite of all that, they're still trading at a discount to their peers. Hence our analyst Mario Mendonca liking that stock at the current time.
Yeah, it's interesting too, because when you talk about catalysts and milestones to watch for them, confirmation for consistent performance to see if they can do a repeat of what they've been doing in the past little while. So great name. All right, so those are 3 names. Again, people can dig into those if they want to get them. Last question for you, Andrew. Just again, when we think about the big picture landscape, there is an election soon. It's Canadian election probably soon too, but the US election we'll talk about first. In the report overall, it does talk about politics, and this is the words of the report, not mine, being an unhelpful sideshow. What does an investor do with that?
So it is going to be an unhelpful sideshow. I mean, those were my words. I stand by them.
They're very illustrative. They're very good.
It's going to be a lot of noise, I think, for the typical investor. What's interesting about this election is if I assume that were you to see a Harris victory, that would be a continuation of the previous administration. This is going to be an election where we've seen 4 years of a Trump presidency. We've seen 4 years of a Biden-Harris administration. So in some respects, that should actually give us more certainty about what the outcome will be. And I will say, in some regards, the 2 candidates probably are going to be implementing policies that aren't as different as perhaps we'd be led to believe. I think in both cases, we're likely to see the U.S. continue running very large deficits, for example, so we don't need to worry about a significant fiscal contraction in the U.S. I don't think, although there will be change in the way fiscal policy is implemented between the 2, we're not likely to see a very significant tax increase if you were to have a Harris victory. So these sorts of things, as much as people are going to focus on the difference between 2 candidates, which in some respects are obviously very significant, in economic respects, they're perhaps not as large as people believe. Now, the big question is around market access to the US from Canadian firms and from global firms. Anything that makes market access to the US more uncertain can only harm investor sentiment from a sort of business investment standpoint. And the other thing to keep in mind is even if Canada is within the sort of trade circle, if USMCA is perseveres, or is preserved, I should say, anything that creates significant global frictions to trade that will be negative for global GDP growth, that will hit the Canadian economy via potentially the energy price channel. So it presents risks. Probably none of them are upside risks.
Yeah.
And I think that's sort of the big picture for Canada. We can see 2025 look a lot like 2024, but there are these downside risks lurking out there.